Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Hi guys, good morning and welcome to Bazaar Morning Call. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I am Reema Tendulkar. With me is Nigel and we're missing Prashant, who is in Delhi and all set to attend the India AI Summit. Hi Prashant.
Here for work, guys. Good morning. Reema, the way Reema put it, she made it seem like
India
I'm here
AI Summit.
No, but you know, it's beautiful here, guys. I must tell you, it's raining. So, you know, there was some low pressure weather system. But it's actually raining in this morning. So the weather is cool, nice, crisp, chilly, whatever you want to say. So yeah, I mean, looking forward to it. So it's going to be an interesting one.
Yeah. Sorry, I was saying, I hope it's not so beautiful that you decide to leave Bombay and shift to Delhi.
No, वो दिन गए. What can I say?
The missus has messaged me, make sure Prashant comes back, irrespective of how much he's enjoying himself out there. Let's get straight, Prashant, to the market action.
Yeah, no, I mean, I think we are picking up on the US market action after one day of holiday, guys, right? So Monday was shut. We have Qs last night. Nothing very decisive with regards to the Qs, but for what it's worth, US markets, I mean, actually, the bulk of the action happened right at the word go. The market sold off about almost 1% at the word go and then picked up in a V-shaped recovery from that point on. So the final close isn't very much to write home about. The S&P was up about 0.1. The NASDAQ was up about 0.14. The Russell, which is the small cap index, ended about, actually absolutely flat. So this is not in any way going to make a difference directionally when you look at things. Oil prices is another story, down 2%. And we were talking about this with regards to US and Iran, how the market perhaps at the margin has kind of given up on this, right? Well, there's news up and down, but nothing really ever happens in a decisive way. But looks like maybe things are happening in that decisive direction. So signs that US and Iran have made progress with regards to nuclear talks. There was the Iranian foreign minister who said that they've reached a general agreement with regards to a nuclear agreement. I mean, the framework, in the trade parlance, we call it a framework agreement, and this sounded something similar. So it's a general agreement. The specifics have to be worked out. I think from the US side, there were some comments which Bloomberg carried that, they are going to come back with, specifics in terms of what they're ready to give and do for the US to agree to some sort of an agreement. So oil, of course, taking a cue there, as I said, down about almost 2%. On the back of it, you also have these assets which do well because of risk aversion, gold and silver, which also sold off. Gold was down 3, silver, I think about $4,800, above 48, but we were at 5,000 2 days back. Silver prices were down about 5.5% this morning. They're sideways to stable. If you look at futures, both gold and silver. The other factor for precious metals, of course, is the fact that China is out, right, for Lunar New Year holidays. So they are not there for the entire week, and that's a very large source of demand and activity and speculation, whatever you want to call it, for precious commodities. So I think that's the other factor. Dollar index was up about 0.25%, so 97 plus. Now I'll just come to the other area which has been the one and only focal point for the market here, which is IT services. And this all, of course, started 2 Wednesdays back in the US with regards to the sell-off in software services companies in US. And just taking stock of where they left off last night. So Infosys was up about 0.25%. But Wipro was down 2%, and the other names, right, they're all up on your screen. EPAM was down 2, Globant was down 2, Cognizant was down 2, and Accenture was down about 2% as well. So doesn't look like there has been very much by way of respite as far as US software stocks are concerned. Remember, Friday, of course, was the absolute low for the IT index. From there, we are up a little bit. There has been some short covering, some recovery, some lower level buying, etc., which has come through. And we'll discuss this. For the first time, yesterday, we heard from IT companies themselves. So far, we've been hearing from, analysts and the model companies and writers, etc., how this is gloom and doom, etc. But now, IT companies are starting to talk. For example, Nandan Nilekani, Salil Parekh of Infosys. We had CVK from HCL Tech speaking with Shireen. So I think, I think we'll hear more. Maybe TCS today, and others as well in terms of how they're, and the message seems to be clear. This is hard work and they are very much required. They need to adapt, they need to change, retrain workforce, etc. But this is not a done deal. What to do with regards to software stocks? I think with so much uncertainty at extreme levels, expect buying to come back. But otherwise, I think the market seems to believe that better to be hands-off right now. Let's see where this settles, where the debate settles, and then we'll start to come in at this point in time. I don't want to take too much risk. Maybe valuations come off more. As I said, at extremes, like, for example, that Friday, you perhaps get some buying interest starting to come back. Otherwise, maybe a little bit of hands-off. I'll just tie in the levels here. The Nifty, I think 25,780 is the resistance for the market. And we're not very far away from where we left off yesterday. Support is very much 25,450. It's still a range. And the market's been trading that range. So at the upper end, we'll see if the market's got enough steam to cross those levels. And if it's not, then you're basically looking at a retest of some of those supports from where the market bounced 2 days back. GIFT Nifty gives you a quick sense of how we're likely to start. And then we'll pick it up from there and take it forward. I think 12 points, so neither here nor there. F&O positioning and what the numbers tell us. Nigel has walked across to the wall with all of that. Nigel, over to you.
Well, in terms of flows overnight, both the institutions were buyers. The FI participation, though, was very, very low. So, yes, we had a positive number of close to 100,000 crores coming in from institutions. But the FIs, it's like, 5-a-side game in comparison to the normal 11-a-side game that you're used to. So that's an important point. Gross participation much lower than what we have seen on an average in February itself. The FIs, well, they added long positions in trade yesterday, but the country remained short with close to 79% of their positions on the short side. But as I said, in the cash market, the volumes itself, the gross participation was 50% lower if you compare it with the averages that we've seen in February. The FIs, well, they added way more shorts than longs on stock futures. And the Nifty PCR that a couple of trading sessions ago had gone down to around 0.64. That's come up to around 1.1. So that's more or less in the middle of that range that we've seen in the past of around 0.6 on the downside, 1.6 on the upside. And there was writing that was seen at the 25,700 strike. That's call as well as puts. Now that's known as a short straddle, which means they're pocketing a premium of close to around 300 rupees. That's the premium between the two. And if you're writing this particular strategy, if you're doing the short straddle, where you're pocketing 300 rupees and 300 rupees higher as well as lower from around this 25,700 odd mark, which gives you the range. On the downside, the 25,400, on the upside, around 26,000 odd mark. That's the important range you're looking at, going by the options data and going by the strategy on the options side. In terms of lower levels, well, the 20 as well as the 200 EMA, that's very important, between the 25,300 to around the 25,500 odd mark. So that range should not break on the downside. Extremely important, particularly this 25,300 odd mark. The tech index, that showed signs of coming back to life yesterday. So just a couple of trading sessions ago, it was at around 31,400. That bounced up to around 33,700, which is, the high that we saw yesterday. However, this level got rejected. If you pull up the intraday chart as well, you'll see this level got rejected. So till that lower level is protected, you'll be hoping for a bit of a bounce. But I think this is going to be a bit of a resistance zone, that 33,700 odd mark, because the way we came off from the highs in yesterday's trading session. I think after a couple of good trading sessions, maybe today the bulls will find it a little bit tougher to fight back. Let's see how that goes.
Got that. Thank you very much for that. Let's get to the equity calls then. It's Mahesh Nandurkar of Jefferies who says December quarter earnings performance was good, with pre-extraordinary earnings seeing an 8-quarter high growth of 18% and a small EPS upgrade. Sequential improvement in growth was seen in most sectors, with lending, financials and staples also recovering. Revenue growth of domestic companies improved to an 11-quarter high of 16%. MSCI India earnings growth for FY26 now stands at 10%. Employee cost growth improvement to 10% is also encouraging. Surendra Goyal of Citi believes potential acceleration in earnings growth from financials, consumer and industrial should more than offset the relative drag from any misses in IT services. Overall, he thinks the risk-reward is favorable due to multiple reasons. Earnings trajectory is improving, the US trade deal should remove uncertainty on exports, and valuations also relatively reasonable post the recent underperformance versus emerging markets in the last 1 year. He adds any moderation in the global AI trade could help India. He says the key risks are further slowdown in jobs, wages growth, although this has been at play in IT services now for some time, and you're seeing that volatility in the flow numbers. December 2026 Nifty target stands at 28,500. All right, let's invite Matt Orton, Chief Market Strategist at Raymond James Investment. Matt, once again, thank you very much for joining in. I need to start the conversation with what's happening around AI back home in India. We've got the India AI Summit. All the big tech titans are, coming here to India. But you know what caught my attention yesterday was Anthropic's update. They've now announced a new update, Sonnet 4.6. And what's remarkable is that it comes just 12 days after their prior update, which is what caused the sell-off in global market. The pace of AI innovation, as AI is getting smarter, that AI is used to build another AI, which is even smarter. It's absolutely incredible, right? That in 12 days, we've got another update, and everyone's watching this with microscopic attention. Take us through your thoughts on this.
Yes, well, good morning, Rima. It is amazing the pace at which things are moving on the AI front. But the speed at which it's moving should also be a reminder to investors that that pace is too quick to really come to brash decisions around what the overall long-term investment implications are going to be to a very large cohort of companies. So last week, I almost described as AI whack-a-mole across the market. I mean, literally, there were just drive-by shootings of a number of different sectors and industries, or anything that was perceived to be at risk of artificial intelligence coming in and taking away kind of future earnings growth for the market. And Indian IT companies were front and center in some of that action as well. But in my opinion, a lot of those reactions are overdone. A lot of high-quality investments have been thrown out with the bathwater. I'm not sure I want to be wading into a number of software names because, again, the pace of innovation is very rapid. It's too soon to know whose earnings are going to be potentially displaced. But a number of companies, and I would argue the Indian IT services names in particular, are really on the AI enablement side. They benefit from more companies, especially in the US and Europe, integrating and using a lot of this new advanced artificial intelligence. And I would also argue a lot of their own businesses can be enhanced for further margin by integrating artificial intelligence as well. So I think these dips are extreme. I'm a buyer on some of these dips once the dust starts to settle and we see a little bit of technical repair to the charts. But I like the setup long term from a risk reward perspective. It's overdone based on where fundamentals are.
Yeah. No, yeah, you mean, Matt, hi, morning. You mean Indian IT services stocks, right? That's what the comment was about.
Correct. That's right, Prashant.
Okay. Got it. Now, the US market itself, Matt, I mean, is what's happening there? I mean, I think Nvidia did well. AMD was down last night. Some are starting to say whether are we finally starting to see on charts, etc. I've seen some start to talk about how these stocks are losing momentum. I mean, at least the large 7 names, 8 names. Is something changing finally, Matt? Yeah.
Something is changing. We're seeing a lot of dispersion across the market, and there's extreme dispersion intra-sector and anything kind of AI related versus those that are not. And I think the challenge, Prashant, with respect to where the market is that while seeing increased breadth and rotation is critically important to sustaining bull markets over the longer term, the challenge is the leadership also has to hold up as well. And where we are is we came from really strong earnings across most of those top 7 companies. And we're seeing significant weakness and a lack of interest in a lot of those names. And that keeps a lid on how high the market can go. And I can't help but think in the very short term that we're likely going to see a break. Something has to break. Either everyone realizes that AI is not going to eat everyone's lunch, and a lot of these market stalwarts, the biggest companies, are benefiting from these trends. Or what I think is more likely is we see a risk-off scenario in the very short term where that dispersion actually starts to narrow. A lot of the big beneficiaries that haven't moved up on fundamental strength, like consumer staples, for example, you start to see some weakness or reticence to start buying that, and you see a sell-off that comes across the overall market. that I think would be the opportune time for investors to start looking to buy the dip, because the fundamentals overall are strong. The macro backdrop is very, very strong. But I think we need to have some sort of shakeout to get investors to refocus on the underlying fundamentals and what are actually driving earnings going forward.
Hi, Matt. Morning. Good to see you in. Turning the attention a little bit away from equities, I want to talk about gold. Ray Dalio continues to sound very bullish on gold. But Bridgewater's latest 13F shows that they've actually exited SPDR gold shares. What's your interpretation of this? Is this the case basically of portfolio rebalancing, or do you think there's a bit of a shift in terms of conviction because gold from the recent peak actually has corrected a goodish bit? So your view on it.
Yeah, it has, Nigel. And I think it's similar to what I've been doing. I'm still very bullish on gold, both this year and longer term, but I've tactically reduced my positioning to gold. I still urge clients to hold at least, 1.5% to 2% in portfolios, if not more, just because of the diversification benefits you get. But gold rallied incredibly hard, incredibly quickly. And so I think it makes sense to take a little bit of chips off the table, allow there to be some repair. We're also in a very seasonally weak period for gold. Whenever you get to the Chinese Lunar New Year, it tends to be a very risk-off period for gold when you look historically. And so I think it's just a tactical play more than anything else. And once we get through the next month or so where we see this historical weakness, that's when I would look to start adding to positioning again, because there's still geopolitical risks. There's still challenges with respect to monetary debasement. We're still seeing central banks buying gold. And so I think that will keep long-term enthusiasm for the precious metal alive.
Matt, good conversation as always. Thank you very much for joining us and speak to you again soon. Thank you. Well, in some important comments coming in from U.S. Trade Representative Jamieson Greer, he said that the Trump administration is open to some adjustments to steel and aluminum tariffs, even though they've been very successful. Listen in.
Well, on steel, remember, we've shipped 300,000 million metric tons more this year than we did the year before. We've produced more than Japan. There was some reporting over the week about adjustments there. I mean, you may want to sometimes adjust the way some of the tariffs are applied for compliance purposes. I'm not giving you double talk here. We've heard stories of companies that have had to hire extra people for compliance. We're not trying to have people, do so much bean counting that they're not running their company correctly. The president's tariffs on steel and aluminum have been very successful, shipping more steel than ever, opening up new steel lines, new aluminum smelters announced. So clearly those are going the right direction. They're going to stay in place. Even if the tariffs affected prices in the way people say, which they don't, right? All the studies are overblown. But even if they did, it's usually a one-time price effect, not a sequential price effect over 14 months. I mean, it's just crazy. If you look at inflation, the actual inflation for manufactured goods, right, which is the bulk of what's being tariffed coming in, was at only 1.1% over the past 12 months. So the idea that the tariffs are inflationary are totally belied by the data. And guess what? That's what happened during the first term too. When we put significant tariffs on China, inflation went down. So all of these studies, all of these things, they're just predictions. They have never come into effect. And this is real money coming in. The point of the tariffs is to reshore and protect domestic production, but all of that tariff revenue has a real effect. And I've had members of Congress who haven't historically been fans of tariffs come to me and say, maybe we can legislate this, because that is actual funding that's going to come in to offset the deficit.
Well, let's tell you what we've lined up this Wednesday morning on our show today. So first up, 8:35, we put the spotlight on the IT stocks. Girish Pai of Bob Capital will join in even after the more than 30% correction, underperformance of the IT sector compared to the Nifty. He is still underweight IT. 9 a.m., Amit Anbani of PL Capital will join in on the recent defense deal wins and the outlook for the sector. 9:20, Kenneth Andrade of Old Bridge Mutual Fund will be a market master. 9:35, we'll bring you a discussion around IT, what it means for jobs with AI accelerating, with Quest Corp's Kapil Joshi and Ramni Datti of TeamLace. Following that, we'll bring you a conversation with Dr. Reddy's G.V. Prasad from the BioAsia conference. Towards the end of the show, Lata will discuss the rout in the IT stocks with Sunil Kaul of Goldman Sachs. Get into a quick break then. On the other side, we'll put the stocks to watch on our radar. CNBC TV18's list of top stocks to watch.
Welcome back. There's 40 minutes to go for the pre-open session to kick off, and there is lots of individuals, single stocks we want to address. So our research team is here with the list of stocks that you need to be aware of, mindful of, and we're going to start with Ola Electric. Sud is here. Sud, good morning. I guess some trouble for the founder and now some relief.
Good morning, Prashant. So Ola Electric is in focus once again, and this time it's not because of the sales or earnings, but it's on the back of the court order. So yesterday, first the order came from the Goa District Commission Consumer Court, which had issued arrest warrant against the CEO, Bhavish Agrawal, and that was related to the plea filed by a complainant known by Pritish Chandkant Gadi. And he had said that issue persisted in his scooter despite the repair work was done by the company, and he had sought refund of 1.5 lakh and 50,000 for mental agony and harassment. But the latest update in that case is Goa bench of Bombay High Court has stayed that arrest warrant and has also observed that Consumer Court has exceeded its jurisdiction in issuing the arrest warrant against CEO.
Okay, all right. Thanks a lot for that, sir. The problem continues for Ola. Let's hop across to Ria. She's tracking a couple of names, Dilip Bilkon and BHEL. Morning, Ria.
Well, good morning, Nigel. Both of these stocks will be in focus today on the back of order wins. First up, Dilip Bilkon has been declared as the L1 bidder for a rupees 702 crore EPC project. This is for the construction of the Narmada flood protection embankment, and the execution period for this will be 24 months. Now, keep in mind that the order book of the company as of the end of Q3 stood at roughly 29,400 crores. For BHEL as well, they have been declared, they have been given an order worth rupees 1,200 to 1,500 crores from SAIL for a captive power plant, the execution period for which will be 39 months. But the order book of the company is quite large, in excess of 2.3 lakh crores as of the end of Q3.
Thank you very much for that. It's over to Sudarshan now once again for the brokerage call of the day. Sudarshan?
So I have few stocks. First one is LG Electronics. GS has initiated coverage with a buy call and target. It's given is of 1,750 rupees per share. It says company is well placed to grow faster than industry near to medium term. And also it has mentioned few catalysts. First, shifting income mix and rising penetration. And that will lead to faster growth in mid and premium products. And consistent track record of innovation enabling the company to sustain premiumization trends. And also global south strategy should enable the company to improve export growth. Next one is Maruti, which had given the price of its electric vehicle e-Vitara yesterday and had the price was 11 lakh rupees. That's looking very competitive. And Nomura maintains buy call. It has given target of 16,118 rupees per share. It says e-Vitara launched. It's launched at attractive pricing and competitively priced to boost EV penetration, but may not be profitable. It assumes 12,000 to 14,000 domestic volumes for e-Vitara and its Toyota variant over FY 26-27. Last one is ITC. UBS has written the note. It maintains buy call, but has cut target price to 395 from the earlier target price of 420 rupees per share. And this note comes after sales channel suggests that company, ITC and other cigarette companies have taken a price increase. So distributor checks indicate range of imminent price hikes is now arriving. 84mm cigarettes is expected to be priced at rupees 24 per stick versus rupees 17 earlier. And this segment has seen the steepest tax increase. 64mm is expected to be priced at rupees 7 per stick versus rupees 5.90 earlier. And pricing of 69mm Gold Flake, which is the volume driver for the company, is priced at rupees 9.50. And for that, new price is yet to be known, but UBS is expecting the price to be around rupees 12 for the 69mm Gold Flake cigarette. Now it is clear that the price hikes have been fully passed on in the premium cigarettes, and this pricing approach, UBS believes that it may keep ITC's volume and EBIT impact to the minimum because of the tax increase that company was expected to see.
Got it. Okay, all right. Thanks a lot for that, Sud. Well, turning attention away from equities, let's get in Manisha Gupta. She's here to tell us about the commodity markets. Morning, Manisha.
Morning, Nigel. Thank you for that. Well, it's a couple of things that the street is watching out for. One, it's going to be the FOMC minutes that come out today and the GDP numbers as well. So gold and silver both have seen a decline overnight. Gold fell 1.5%, while silver fell 2.5%. The dollar index steadying above 97 also was putting some pressure into the markets there. it's not just precious metals. Energy also has seen a bit of a knockoff, especially with the crude oil prices down by nearly a percentage point in the overnight market. The US and Iran conversation seems to have progressed well. We have heard statements from both of those countries' premiers, and the US-led Ukraine-Russia negotiations also seem to be moving in right direction, is what we hear. And that has taken some geopolitical premium off the prices. It's the same case for metals as well. Profit taking coming in for that one as well. Copper is trading at around, we have seen 6-week lows come in case of the copper prices. Nickel is trading at a 1-month lows. Lead is trading at an 8-week lows as well. Platinum has declined to 2-month lows. If you look at the last 1 week, actually, gold is down by 4%, copper and platinum down 5%, zinc is down 4%, nickel is down 8%. So the last 1 week, including today, has been bearish for many of these commodities.
Manisha, thank you very much for that. So that is the commodity and the pressure side of it in focus there. More later. We'll take a quick commercial break here, and we're going to come back in just a bit from now to connect with Girish Pai of Bob Capital Markets. And Girish, of course, has seen the IT services space for a long time. We'll ask him what is his view with regards to these stocks now after the sell-off that we've seen. Stay tuned. Coming up.
Welcome back. Tech top of mind, and the India AI Summit is underway in New Delhi. And from there, our team has been getting you a lot of big voices on the AI disruption, where the industry is headed. Yesterday, Shireen had a chat with C. Vijay Kumar, MD of HCL Tech, and he shares that there will be a 2 to 3% annual deflation, but that is already modeled into their business plans. Listen in on what he had to say at the annual AI Summit on the way the industry and the company is headed.
We believe there will be 2 to 3% deflation at an overall level because of AI. And this is something we've modeled. But there are at least 5 mega opportunities that we are chasing, right? AI factory, it's $1 trillion capex will mean at least $100 billion of services spent, and at least a couple of $1 billion we should be able to get from that. Physical AI is again another big opportunity. The whole agentic implementation. See, there is a huge legacy install base. We had called out about $600 million annualized revenues, advanced AI, and once again, this is different from regular AI revenue a lot of companies are talking about.
This point about 2 to 3% annual deflation is important because the fear was that on account of AI productivity, clients will ask for more discounts or pricing reduction, which will result in higher revenue deflation, maybe 5-6% or perhaps even higher. But the management of HCL Tech says that it is 2 to 3%, and that's already a part of their business model. But yesterday was also the Infosys AI Investor Summit, where the management outlined their AI-first strategy and how they're positioning themselves for the next technology cycle. Importantly, the company also announced a collaboration with Anthropic to unlock AI value across the complex and regulated industries. Listen in to what Infosys had to say about the AI opportunity.
There is no opportunity gap. If anything, the opportunity is bigger than ever before. So don't get distracted by that. You should still ask the question, what is the firm doing to take advantage of this? What is the firm doing to transform its talent for this new world? What is the firm doing to design the services and products for this new world? What are they doing to tell the customer in a way that it resonates? What are they doing to make sure that the front-end conversations with clients are done properly? These are all the issues, and I'm sure everybody will not execute the same way. So there is an execution risk in doing that. So it is not an opportunity risk, it's an execution risk.
Okay, and after that, we had a lot of brokerages that have come in there and written on Infosys. Rima, tell us, what are they saying?
Well, firstly, yesterday, they also for the first time gave an AI number. TCS was doing it, HCL Tech was doing it, but Infosys up until now did not do it. What they said is that the new AI services, which is basically generative AI, is now 5.5% of their overall revenue. And the AI opportunity, the generative AI opportunity, is seen at $300 to $400 billion by 2030. That number was known yesterday because Salil Parekh had shared it, the AI opportunity. But the fact that AI is now 5.5% of their revenues is something new. Brokerages are largely positive, just running through the calls with the target price, starting from the top. The most bullish appears to be JP Morgan from what we've seen, with a target price of 2030. Then you've got Nuvama, 1900, Jefferies, 1880, HSBC, 1870. You go down the list, you've got CLSA, also an outperform rating, 1779. And then you've got a Morgan Stanley at 1760. So broadly, brokerages are still very bullish, and they believe that Infosys will be able to ride out the storm. But Girish Pai, research analyst, head of institutional equity research at Bob Capital Markets, is now joining in. Girish, thank you very much for joining in. You have a hold call coming through on Infosys. Your target price is down to 14.14. But first, let's begin from the top. The call on IT, and what did you make from the Infosys Investor Day? What were your key takeaways?
Right. Thanks for having me, Rima. So basically, I would say what Infy said yesterday during its Investor Day is very similar to what I heard from TCS 2 months back when it held its own Investor Day in mid-December. So basically, both are saying that there is a fairly significant opportunity ahead of them. At the same time, they're saying that this disruption is very different from the ones that we've seen in the last 20, 25 years. My own sense is this disruption is very similar to the offshore delivery disruption that global IT services have seen. So that's a point number one. And I think that is very critical in the sense that this disruption could mean that there could be new winners and losers. That's something that we need to kind of watch out for. The other couple of data points I want to share with you is what Nandan shared in his presentation. So he talked about a deployment gap. So obviously tech has run away at a very significant pace, and enterprise adoption has been lagging. That is one. This is very similar to what we heard from various companies during the digital cycle, which happened in the last 10, 15 years. Very similar situation where cloud adoption kind of lagged the technology that was moving at that point in time. The other interesting aspect that he mentioned was 92 million jobs are going to be displaced and 170 million new jobs are going to be created. The issue here is you don't know the time frame. The 92 million jobs displacement could happen in a different time frame compared to the 170 million jobs, new jobs being created. So that could mean challenges. So when I look at the sector, why I'm underweight in the sector, while optically the sector looks cheap from a PE multiple perspective, tier one companies are coming at on a 1 year forward basis, slightly below the 20-year mean. And from a free cash flow yield perspective, they're very attractive, maybe closer to like 5% free cash flow yield. But the issue is, what is the trajectory of this cash flow? What is the trajectory of the earnings going forward? It's something we're not very clear about at this point in time.
So the big gap or the big argument that Indian IT companies are saying that there is a difference between the potential of AI and where AI is deployed right now at an enterprise level. You know, as Nandan said, it's easy to get productivity gains when you're looking at it from a particular task. At that point, the productivity gains can be very high, 15, 20%. But when you have to do it, when you have to implement AI at scale at an enterprise level, it's hard to get that level of productivity. But don't you think with the way at which this may be true for the next 1 or 2 years, but is it possible that 2 years down the line, the gap between the potential of AI and the deployment of AI at an enterprise level, the gap between the two gets bridged, and that's when we start seeing massive disruption? So maybe the earnings are fine for the next 1 or 2 years. We haven't seen EPS downgrades yet. All we've seen is a PE derating. But that changes 2 years down the line. Do you see the gap between the two getting bridged?
Yeah, that is the exact point I'm making, Rima, that we're not very clear about what could be the trajectory of earnings and cash flow growth from here on. FY27 earnings and cash flow is probably protected, but the way the fundamental models, the foundational models are kind of rapidly changing or improving. So if you look at the data that Nandan provided in his presentation, the foundational model improvement has been to the extent of 10x to 5 to 10x over a 2-year time frame. I'm not saying that pace could continue going forward, but that could, it could be a 2x, 3x improvement in the next tranche of releases that can happen. So I would say that the foundational models are improving, and including various tools that are kind of put in, they are becoming more and more, I would say essential, or I would say important in one sense. So I would say the deflation story is yet to play out. And as I mentioned, the numbers, the jobs displaced are about 92 million. Around what time frame when the numbers are being discussed, I'm not very clear. And 170 million is the number talked about for new jobs. That could be over a longer time frame. So that is the basic call. And again, regarding deployment, the issue is that the current situation is, I mean, if you heard the numbers, it's about 4-5% of revenues coming from AI right now. This is after a 3-year time frame, and the ChatGPT moment happened in November 2022. All the companies have been working on it, but we only have about 4-5% of revenues coming from AI, so advanced AI, so to speak. So I think the enterprise uptake has been fairly poor, and I would say that that is dependent to an extent on whether the ROIs are going to be generated. One of the issues is that there are surround services out there which are very expensive, and I don't think the enterprises see it as a situation where they can get very quick ROIs on an enterprise level implementation of AI. In pockets, it could be interesting. And when you look at the presentations of both TCS and Infosys, what you hear is discussions around productivity gains and cost savings and stuff like that. It is nothing beyond that at this point in time.
Yeah. Girish, morning. So what's actionable here? Is there anything actionable for those who own these stocks and those who don't own these stocks? I mean, for both sets, what should one do?
It's a tough call. And as a sell-side analyst, it's my occupational hazard to kind of make these kind of one-year bets, one-year calls. So to that extent, I now have, as Rima mentioned, I have a whole lot of stocks which are holds at this point in time because they've corrected quite a bit. But I think we're probably getting into a bit of a value trap here. Again, things are not very clear. This is a material disruption of the industry. We don't know what happens 2 3 years down the road. Who are going to be the winners and losers. So very difficult to give a call out very specifically that X or Y stock is going to be the winner, and therefore you need to take a bet on them. I would say be underweight the sector, we have some hold calls which are on Infosys, TCS, Tech Mahindra, and Wipro. So broadly, those would be the tier 1 bets that we would have. On the tier 2 side, I would probably bet on FirstSource and eClerx.
Yeah. FirstSource and eClerx are 2 buys right now in your...
No, only FirstSource is a buy. I would say eClerx is a hold.
Okay. Yeah, I mean, it's one of those times, right, where it's kind of hard. It's foggy and all of that stuff. But thanks very much, Girish, for that. Appreciate it. We're going to take a quick commercial break here, and we'll come back with more on the other side. About 15 minutes to go for the pre-open session. Stay tuned. Okay, welcome back. There's 14 minutes to go for the pre-open session, and I think GIFT Nifty is still indicating a flattish kind of start, neither here nor there. The big movers from yesterday, and there were quite a few, and what did delivery numbers, volumes, etc. look like? Let's go back to Sud. Sud, morning.
Morning, Prashant. So some interesting names. So on top of the list is Unicommerce eSolutions. Yesterday's stock has hit upper circuit of 20%. And if you talk about the volume, it was 94 lakh versus 10-day average of just 13 lakh. And remember, on Feb 13th, the stock had hit 52-week low of around 95.40 and had fallen below the IPO issue price of 108. But the up move came after the company released Q3 earnings on Feb 14. And in that, it has one of the important, our main platform, that is Uniword. And now for that, company is expecting double-digit growth from Q4. And for the same platform, in Q3, the growth was in the range of 7 to 8%. Next name is Indo-Farm Equipments. So stock had hit 52-week low on Monday, that is Feb 16. It's still trading below the IPO issue price of 215. And after that, it has started seeing an up move. And on Tuesday, the stock has surged 16% and volume was 23 lakh versus previous 10-day average of just 6.6 lakh. The reason of up move, promoters have increased the stake. On Feb 13 and 16, promoters have gone ahead and bought shares from the open market. Next name is Gandhi Tubes. So yesterday it saw volumes of 6 lakh versus previous 10-day average of less than 10,000. If you talk about the stock, it was up 13% on Tuesday, and this month the stock is up 26%. But the interesting part is it had started seeing volume increase ahead of its earnings on Feb 10. On Feb 9, volumes were 10,235 versus previous 10-day average of just 3,000. On Feb 10, the day the company released Q3 earnings, volumes increased to 31,540 versus previous 10-day average of less than 4,000. And the reason of continued up move, company's earnings were good, revenue had increased by 20%, and margin was up more than 300 basis points. Last one is RACL Geartech. Yesterday also I did talk about this stock. So for second straight day, it saw healthy volumes, and the stock was up 13%. In the last two sessions, the stock has moved higher by 36%, and this month, the stock is up 60%. And volumes on Tuesday were at 30 lakh versus previous 10-day average of less than 24,000. But delivery percentage was low. Yesterday, it was just 5.6% versus last 10-day average of 42 to 43%.
Thank you very much, Sud, for that. So again, lots of movers, single stocks moving around with heavy volumes around. Devin Chokshi is with us. Devin, good morning. Good to have you with us here. Thanks for joining in. So, I mean, where are you most focused, Devin? The new stuff, not what you already have owned, but new interest areas or new actionables. What's on your mind?
Yeah, Prashant, good morning. Well, I think given the kind of larger activity participation that India is doing with European nations and also with America, we have been looking at some of the businesses afresh, I think, including the companies which are there in the FMCG business as well. Some of the companies have their global parents sitting in Europe, and I think they have the possibility of integrating further into India. Currently, I think the about 5% or so to 5 to 10% kind of a business, I think, comes out of exports for them. We see a distinct possibility down the line 2 years, the export business could pick up for some of the Indian MNC companies and FMCG companies to around 15 to 20%. That is a possibility that we are seeing. And that too at a margin which is possibly higher than what India is producing. So the blended margin probably for Indian FMCG companies could possibly show relatively better performance. And that has started appealing us because I think if FMCG is one such area, I think there are many such other areas in which the businesses are getting integrated with the global players. Yet it is a little early to conclude that how much it is going to be turning out to be in the volume terms and the business revenue. But I believe that I think the initial moves as a green signal that we are getting from some of these companies, we see a possibility of some businesses doing well, including the companies which are providing the end-to-end solutions, say, for example, names like Tata Technology, where they are providing end-to-end solution to some of the European OEMs. And that's where probably the business is looking relatively more stable for them. The inflow of new orders probably, I think, showing some more positive directions. So selective companies, yes, I think we are looking at, given the kind of a larger environment change that we are experiencing right now.
Okay, hi Deven, good morning. Good to see you in. Deven, I wanted to ask you about the gold financiers, namely Muthoot. Stock did very, very well. Gold prices were in an uptrend, which was good for business, and cost of borrowing was expected to fall. Now the problem is that the cost of borrowing actually didn't fall in the past quarter, and as the management clarified, that will happen with a bit of a lag. In addition to that, gold prices have come down as well, which has hurt sentiment. Stock is not cheap, but what's your view on Muthoot Finance, since that's been the leader, that's done very, very well? And in the same light, would you actually look at Manappuram now?
Yeah, Nigel, good morning. Well, as a strategy, we find ourselves more comfortable with the NBFC companies which are retail-focused NBFC companies and which are not particularly vertical-specific NBFC companies like gold. Even though I think we find that I think some of the housing finance companies as an exception to this rule, we believe that I think the companies which are catering to the larger part of the investors through the retail lending they are relatively better off. And I think the story in companies like Bajaj Housing Finance or companies like Bajaj Finance, they appeal us more because they're using the advantage, you are using the technology to disperse the loan faster. They're using the technology to reach out to their customers faster. They're using the technology to, I think, underwrite the credit risk in a much better manner. So we like this kind of company who are using the technology platform to the core level. And that's where I think we do not end up necessarily focusing on a particular segment like gold as far as NBFC business is concerned.
Devin, have you analyzed some of these BPO companies? 2-3 years back when AI was just gaining traction, generative AI, everyone thought that they would be the big losers. But actually, they've adapted themselves pretty well. And we were just talking to Girish Pai of Bob Capital, and he's underweight on Indian IT even after the underperformance. And he says the only buy call that he has is First Source. And even a couple of other people, like this entire BPO space, the Sigility, eClerks. What is your analysis of the KPO, BPO business listed here in India?
So, Rima, we believe that I think this particular business is undergoing a transformation understood fully. And I think they're using AI agents at the forefront in probably producing the solution. I'm not too sure whether these companies have actually started changing their revenue model. The revenue model, if it is becoming an outcome-based revenue model, which means I think the kind of KRS that they would assume from their clients, if they end up, I think, providing services in that direction, in my viewpoint, I think they could possibly be having a relatively better revenue going forward. But whether this transition is completely happening at this point of time or it is still in transition process, I'm not too sure. So we are not taking any fundamental call on these companies. Studying, I think, how the business model is changing at this point of time for some of them.
Got it. Any view, Devin, on some of these product companies? Yesterday's stock like Newgen was up more than 10%. The stock has seen a fair correction, but these product companies, in fact, could look a little bit interesting. Your view?
No, Nigel, immediately I think nothing that we have seen in this kind of companies. But we believe that I think many of the Indian mid-tier IT companies, which are actually providing the productized solution to their customers, they are relatively in a better position to win new contracts. That is what I think we are getting the understanding from some of these companies. But nothing on horizon as far as our recommendation basket is concerned.
Okay, thank you very much for joining in. We will slip into a break. On the other side, we'll get the pre-opening rates. We'll also be joined by Amit Anbani of PL Capital to discuss the recent defense deal wins and the outlook for the sector. We'll also get in our technical ideas for the day with Sudarshan Sukhani and Mitesh Thakkar. Stay tuned for that.
Welcome back. In the next few minutes, we'll be getting the pre-open rates. For the time being, let's find out how you should approach trade. Sudarshan Sukhani as well as Mitesh Thakkar join us on the show. Good morning, gentlemen. Good to see you in. Well, last couple of trading sessions have been pretty okay for the bulls, but we need to note that FI participation was down by 45 to around 55% or thereabouts. What's your view on the index? Sudarshan, you go first. I think yesterday you had stay away from the index. Do you hold on to that, or do you believe now there is a trade?
Yeah, good morning. Well, yesterday again we went to and tried to test the lows that we made on Monday, but that was successful. The test was there. We did not go to Monday's lows and we bounced from there. That's the first suggestion that maybe, at least for the time being, a low has been made. I would suggest that today could be a choppy day, but we are willing to be buyers today, not at the open, not at current prices, but a small dip towards 25,650 is a buying opportunity. That gives us a lower price to enter. Your stops will be 25,550, a 100-point stop loss approximately. If you get a dip, go and buy. In the unlikely event that you don't get a dip, then there's no buying.
Okay, all right. Buy the dip, and the stop loss for the day is 25,550. Got that, Sudarshan. Mitesh, coming across to you. How are you feeling about the index?
Nigel, actually, I would be watching the upside level of 25,750, 780 closely. I would hope that the index manages to capture that. And if that happens, then I think a retest of 25,950, 26,000 would happen. The encouraging part in this entire scene is the bank nifty, which continues to close at higher levels and is showing good momentum. So broadly, that's the breakout level, about 25,780. And in case we fail to do that, then we are doing a range of about 300 points, 25,780, 750 to about 25,400, 450.
Gentlemen, morning. Good to have and good to see both of you. Mitesh, what about stocks? What would you trade?
Prashant, I have 3 buys to a sell today. On the buying side is Bank of India with a stop at 167 and 177, 178 here could be a good short-term target. Also buy on Adani Greens with a stop at 999 or just below it and a target of 1050 is what I'm looking at. Gas Authority has turned positive after a big correction. So GAIL is the buy with a stop at 163 for a first target of 171.5. And one sell call, that's MCX. It's close below all its short-term averages. Could see some more supply pressure. So MCX is a sell with a stop at 23.34 for targets of 21.85.
Okay, all right. Sudarshan, what about you?
Well, I have GAIL also, the same thing as Mitesh. GAIL is a buy with a stop under 160. BEL is a buy with a stop under 440. M&M is a short with a stop above 35.60. And Syngene is a short with a stop above 15.50. The shorts are essentially taken if you see the markets start sliding below 25,600.
Got it. Okay, all right. Gentlemen, thanks a lot for joining in and giving us your thoughts. We come back to you rather soon. Let's welcome Amit Anwani, research analyst at PL Capital, who joins us on the show. And we're turning the spotlight this time around on the defense space. Hi, Amit. Good morning. Good to see you, Ben. Plenty of news flow, right, with regard to the defense sector? Budget allocation was pretty okay, budget 2026. So that one fear got dispelled. Besides that, India has approved the purchase of 115 Rafale jets at a cost of around 3.2 lakh crore or thereabouts. The focus is to strengthen the air power dramatically. Who would be potential beneficiaries here in India? And you could give us rationale on that?
Right. Morning, Nigel. So if we talk about the recent deal, which is my stock 114 Rafale, I think in the past also we did a couple of deals, 36 Rafale and the follow-on deal in 2025 for 26 more Rafale. So one thing which I would say the outcome of these deals definitely is the depleting squadrons with respect to IF. And we have seen MiG-21. There are multiple platforms which will be phased out, and probably few are already phased out, including MiG-21, MiG-29. We're talking about Jaguars getting phased out, Mirex getting phased out. So if you see in terms of requirement of fleet, in terms of squadron, we are probably have reduced to 30 versus the approved 42 squadrons. So I think this is also one of the kind of urgency which is driving even the government-to-government deals outside. But one thing which was notable even from the past deals, there's been a lot of emphasis on the technology transfer and offset clauses in the past. And I think the upcoming deal also emerging in a way that probably there could be 40 to 50% locally manufactured indigenous component even in Rafales going forward. So definitely this should benefit the private defense ecosystem and probably the MROs and the other services being talked about once the details of the deals are out. But quite interestingly, if you see the requirement of aircrafts in India is massive. So if you see, including just to meet these shortfalls which are getting phased out, you probably need at least 200 aircrafts over the next 7-8 years and probably 400 plus aircrafts in next 12 to 15 years. So I think this definitely will boost the domestic manufacturing ecosystem and benefiting probably many private defense companies plus defense platform integrators as well in the future.
Got that. Where are valuations at? If you can just kind of sort of, there are so many names, right? So, and there's going to be growth across the board. Order books are bulging. But where are valuations now looking attractive? I mean, you've got to buy at the right price, right? Otherwise, you hang around a long time without, and pay the price for it. So where are valuation and prices looking good?
If I kind of dissect the platform OEMs, including HL, I think HL valuations are a bit comforting to me. On my numbers, the stock is trading about 27x 2-year forward on March 28th. And I believe, of course, there's been some delays with respect to deliveries, which probably I believe now the supplies have started next year could be better than today. But with the kind of book they have for multiple helicopter wins which they had and the follow-on order for LCA, I think the pipeline in terms of execution is robust for next 7-8 years. And currently valuations are bit comforting for me in HL. But on the other end, we are seeing even shipbuilding, there's a very strong pipeline. I don't have the coverage right now, but probably the pipeline is upward of 1,50,000 to 2 lakh crores for next 2 years. GRSC seems to be, and MDL seems to be the beneficiary of this long pipelines, and their order books could probably see a significant increase once these orders are cleared. So this few shipbuilding stocks, which are a bit comforting, and HL, as I highlighted to you. Defense electronics, I think the stocks are trading between 35x to 45x. Still, there is no major comfort. I would
Can I just come in? Sorry.
Yeah.
If I can just come in, Sorry, can you just the names, if you can run through the names that you've mentioned so far, and then we'll continue. There was a bit of audio disturbance, so I'm not sure if viewers got all the names clearly, but just quickly, just run through the names again.
Yeah, so I said HL is something which is comforting, which is trading at about 27x to my 2-year forward numbers. So that is one stock we are comforting, considering the very strong order book. We believe that probably gradually the deliveries will start for LCA, and that can significantly increase the manufacturing revenue with multiple other helicopter platforms coming in. I said the pipeline for shipbuilding looks very strong. There, I believe GRSC, MDL could be beneficiary of this massive, strong pipeline. We're talking about at least 1,50,000 to 2,000 crore pipeline, including many projects like P-17 destroyer, Bravo, and the few submarine orders which are on the anvil to get cleared. I think the valuation discomfort is bit, I think, on the defense electronics side, where there are many private companies also, and even Bharat Electronics trading at about in the range of 40x 2-year forward. So this is an area where probably the valuations might command some premium to the platforms and shipbuilders, but still the comfort level for me currently is kind of wait and watch here. Yeah.
Yeah, and MTAR, etc. as well, right? In that electronic space, basically, and there are a few others as well.
Yeah.
Yeah, where you're saying valuations are a little on the higher side, but your clear picks are HAL and Garden Reach in that sense.
Yes.
Yeah, got that. What about names like Solar and there are a few others. Individual sort of companies really focused on, for example, Solar is Pinaka and. Good capabilities there, but again, valuations, I remember, used to be 100 times and all. So, any sense looking at those names?
Yeah, if you see the valuation in the near term might look expensive because there's kind of J curve which is coming, the kind of order book all these companies have built, and once they have the base year where they're able to execute few of these orders, probably valuation might look normal. But speaking about solar industries, definitely, as you said, Pinaka, they won the large order last time, and their order book for defense is quite attractive. They're also looking for a few orders on the UAV side, plus the follow-on orders for the high range of Pinaka. And we have seen the AON approvals or the DAC approvals in the past includes a good proportion for missiles and UAVs. There's been a lot of focus on drone UAVs and missiles. Definitely, they should be beneficiary, and they have been talking big in terms of defense as the orders have started coming. If I gather it correctly, they already have roughly about 13 to 14,000 plus defense book. But as you rightly pointed, even 2 year forward, I think the stock should be around 44x on consensus numbers, which is kind of discomforting at the moment. Yeah.
Thank you very much, Amit, for joining in. Let's get in some 9-10 calls. Sudarshan is back with us. Sudarshan, hi.
It's BEL, buy BEL with a stop under 440.
Okay, defense in focus. Mitesh, yours?
I'll go with a long call, and that's a buy on Bank of India for targets of 177.
Got that. Infosys should be on your radar. Yesterday, Infosys rebounded. The stock ended up in the green with a gain of close to about 2%. For the first time yesterday, Infosys shared how much generative AI or new AI services contributes to the top line, and that stands at 5.5%. Now, this is largely similar to what peers are reporting, large cap peers. For TCS, it stands at 6%. For HCL Tech, it's nearly 4%. But the definition of what constitutes advanced AI or generative AI may differ. But largely, you can gauge that it's about 5% of the overall revenue today is AI for these large IT companies, and it's growing very fast. Now, the question is, should you be disappointed, as Girish said, because AI has been around for the last few years and it still is only about 5% of their revenues, or would you see it as a glass half full and say that, well, look at the headroom then for the contribution of AI, which also helps you get higher margins expanding from here on. There is significant headroom. Brokerages are largely bullish. JP Morgan's target price stands above 2,000 rupees, 2,050. For Nuvama, 1,900. For Jefferies and HSBC, it's about 1,870, 1,880. CLSA has an outperform call. Their target price is 1,780. And Morgan Stanley has an equal weight on Infosys, 1,760 is the target price. So largely, brokerages are still bullish on this IT major. But over to Mangalam now for more on Dabur.
Well, Dabur will be in focus because Harjeet Bhalla has been appointed as the India business CEO for the company. Their current leader, Mohit Malhotra, has been elevated to be the global CEO. So Harjeet will actually be reporting to Mohit. Importantly, Harjeet comes with experience from Unilever, the Hershey's company, and he's also worked at Metro, Cash and Carry. So what his channel strategy would be, what he tries to do with regards to category growth and how the company goes ahead and makes bets on digital with the Dabur ventures that they had announced a couple of quarters ago will be extremely crucial to track. For consumer companies, the change in leadership or addition of leaders coming in from companies like PepsiCo or Unilever, etc., is an important inflection point. So let's see the middling growth that Dabur has been reporting lately, with the consumer sentiment likely to improve and them having targeted mid-single-digit volume growth in FY27. Can there be further acceleration or not is something that we'll be tracking.
Yeah, absolutely. And we'll keep an eye on this one. Thanks very much, Mangalam, for that. I mean, I think we've got, little over a minute to go for market open. It's going to be slightly higher, 30 points up on the Nifty, the sensex about 100 odd points. If we have time, maybe just put out a stack of IT stocks, right? IT software stocks, and where they're in the pre-open, at the end of the pre-open, that is. So your Infosys is the Wipros and the HCL and the Tech Mahindra, the large cap, and of course otherwise as well. It's up. The index itself is up about 0.18%. Infi is up on your screen. TCS is up about 0.5, and you've got HCL Tech, and so there is small green. Wipro is up about 1/3% as well. Tech Mahindra is up. Maybe just look at Coforge and Persistent and others as well in the mid-cap arena. 1/3% higher on Coforge. Persistent is up a little bit. I mean, all these stocks, of course, 8-10% off the lows, absolute lows, panic lows that we saw on Friday. But, I mean, these are still feeble recoveries in that sense. So just first trades, and we'll look at the Nifty, the indices as we always do, the Nifty, Sensex, etc., and then we'll look at the heat map. And of course, individual single stocks. I mean, the earnings is behind. The earnings season is behind us. So you don't have, as we've had now for the last 1 month during the earnings season, a lot of earnings, that stocks that react to earnings. But there is other news flow, a little thinner though. What do we have? It is absolutely flat, nothing on the Nifty. Blinking red and green, undecided. Nifty Bank is up about 0.1. You've got the Nifty, the mid-cap index, which is up 0.04. Again, nothing. And the small-cap index, I guess, should be something similar as well. 850 up and about 540 lower. That is the advances to decline ratio. The heat map should give you a sense of where we are starting, and then we'll pick it up from there. So, I mean, I guess, given the state of the Nifty, it should be kind of split right in the middle. What do we have? Yeah, I mean, absolutely. Split right down the middle. Eternal, BEL, Hindalco are some of the names which are higher. On the other end, you got ONGC, Infosys, and Tech Mahindra. So that's a start. 6-point change in the Nifty. Absolutely flat screen. Rima.
Well, profit booking visible in the large cap IT names after yesterday's mini rebound. Infosys down nearly 2%, so giving up all of yesterday's gains. That's one of the big losers. Tech Mahindra, HCL Tech have a decline of more than 1%, so Tech Mahindra is sliding nearly 1.5%. For TCS and Wipro, the cut is about 0.5%. ONGC is your top Nifty loser. That's seeing a cut of nearly 3% now. Coal India is under pressure. Then you've got a lot of these IT names. Adani Ports is under pressure. Power Grid, Nestle, NTPC, Tata Motors, passenger vehicles. Across sectors, some of these stocks are opening in the red. But it's a flat start. On the way up, you've got BEL. That's the big gainer. Stock is now up 3.5% in the last 3 trading sessions. Hindalco, Tata Steel seeing some buying. Eternal is gaining. Trent, Ultratech Cement, ITC also up. But very, very quiet move. In terms of a sectoral trend, if you have to discern something, it's that IT once again is on the back foot and some profits are being taken off.
Well, that's right, Rima. You know, a few stocks in the broader markets, though, they're calling for attention. CE Info, well, that one's up close on 7%. So big move is what we're seeing on that particular name. And Cohance, another stock that's seen a sharp correction from the recent peak. Well, that one as well is buzzing in today's trading session. Besides that, a few of those gainers yesterday, they're continuing with their winning ways. Case in point being a Unicommerce Solutions. That stock is up. Easy Trip, a stock that's underperformed big time, that as well is up and about. And NetWeb, the products company, yesterday I think the stock was up close to 12%. Today as well, it's seeing some follow through with a gain of close to around 3%. And that's on rather good volumes as well. So just keep an eye out on that one. Dilip Bilcon's another stock that's doing pretty well in today's trading session. So keep an eye out on that name. On the flip side, your matrimony.com, well, that stock, in fact, has come in for some profit taking. That's down, I think, close to around 6%. GE Power as well, the stock had a good run, but that as well has come in for some profit taking in today's trading session. So, things are looking pretty okay, at least for the broader markets. On the headline index, it's as flat as can be. And NetWeb is a stock that's up close to 3%, but I think NewGen, that's the one that I was referring to with regard to a products company. It's seen a sharp correction from the recent peak. Yes, it was up 10%, and NewGen is up even in today's trading session. I think it's up close to around 4% or thereabouts. Rima?
Okay. All right, that's the state of affairs as we open trade unchanged on the Nifty and the Sensex. Kenneth Andrade, CIO, Old Bridge Asset Management, is now joining on the show. Kenneth, great to have you this morning. Thank you very much for joining in. I suspect the first one of 2026. We're chatting with Kenneth, so it's been a while. Thank you for joining in. So let's begin with how you see the markets. It's been about 1.5 months. It's been extremely tough for the technology names globally and back home in India. At Old Bridge, what is the analysis?
It's firstly on the marketplace, it's a very rotational market. And while technology has been holding steady for the last 6 months, it's their turn to actually take some money off the table. The question remains out here is, are these companies running to stand still? Or you will find a few businesses out there that could actually use the opportunity to scale up quite dramatically. I think that question is not very clear at this point in time. What is a question mark, which I think everybody out there already knows and understands, that this is not status quo. This technology change or this automation is not status quo for a lot of businesses. And I think that's what the markets actually are reacting to. So from a standpoint of just IT services, it's not very clear how companies will adapt and how fast they will be able to adapt. But there will be a lot of uncertainty on how these businesses will meet any kind of growth trajectory, at least in the near term. One thing I must say is completely in favor for these companies is that historically they are quite quite comfortable in terms of where their valuations are. I mean, extremely comfortable in terms of where their valuations are. But with all the uncertainty around, I'm not too sure that will be the best part of the marketplace to be in.
Kenneth, hi, good morning. Thanks for joining in. Now, wear your mid and small cap specialist hat, Kenneth, if you will, and and tell us where, because that is where sometimes stocks get thrown away because of whatever reason, and we've heard it from other veteran fund managers as well, that's the opportunity when people. Long-term investors get frustrated and say, I mean, it's idiosyncratic. I mean, it's not one sector which has a big, huge tailwind or anything, but good businesses which now have fallen quite a bit. So, where are those opportunities, Kenneth? And let's talk stocks for a change, Kenneth.
Right. So let me try and put this together, right? It's an opportunity in the making, and you'll see all of it in 2026. Stocks are half from where they used to be. A lot of them are down from where they used to be, and some of them are 50% from where they used to be. Numbers are nice. Balance sheets are consolidating. So there's no debt. There's cash on balance sheet, and market caps are down. There is a lot of uncertainty on how these companies will meet any kind of growth trajectory. And I think you will get a handful of stocks, if I'm not mistaken, or even more that we can come across, which are already in that zone. So whether it is mid caps, small caps, large caps, I think this marketplace is opening up, or 2026 is opening up to be a great stock pickers market, or a great time to put a portfolio in place. Now, let me try and rewind this by a little bit of industry data that is out there. There are a couple of industries out there which are already through their capex cycle. Okay, the one industry that went through a massive spike post the pandemic was chemicals. A lot of capex came into play. And they are at the end of the capex cycle. Commodity prices are not supporting that capex, but none of them are losing money. The second one, I could also say very safely, is almost an adjacency of that business, which is pharmaceuticals, and especially on the chemicals and on the chemical side. There also, capex is behind a lot of large and mid-sized companies there. But the opportunity is still probably a couple of years away. I won't say a couple of years away. Some part of that is already showing up in balance sheets. So take those two sectors and park them. They have done nothing in the last, I would say, 4 years, or the last probably 5 years. They've done nothing in the last 4 to 5 years. The other one that has done reasonably well, at least in the near term, has been automotive and that entire value chain. You've got some significant capex coming up in that sector, and it's an ongoing capex. If you take the large companies there from an OEM perspective, you will get reasonable amount of growth. Valuations we can obviously debate, but these are large companies, very well diversified, very well researched, and all data that has to be there is already out there. Then you break it down into a couple of the value chain, the automotives, etc. And I think you will get reasonable amount of growth there. Valuation also in some spaces are okay. And then the most important part of that entire value chain is the financials. Okay, the lending businesses. There, I think across the board, and we've been saying this for a while, is valuations are reasonably comfortable. But there is an absence of growth on the corporate lending side. Apart from that, I think we are cyclically all over the place as far as household lending, automotive lending, everything else that is concerned out there. But valuations are now capturing all of that is out there. So you're setting up for a nice 2026. But we're a little cautious that we're getting into financial year 2027, saying that that earnings growth will be double digit into year 2027. But that's always a narrative that's within the marketplace. just before the new year starts or new financial year starts. So I'll be a little cautious of that kind of optimism because the market actually lacks a little bit of demand both domestically as well as for all what has happened internationally. I think the supply chains still have to get put into place. India still has to find its space in the international trade. So I think we're set up for a nice, quiet 2027. But at the same time, the underlying opportunities that are there, look for companies where CapEx is behind us, look for industries as a whole subset, which has faced a lot of pricing pressure, which effectively means no inflation that is there. And you should be able to put a portfolio together in 2027, 26 into 27.
Yeah. That's well explained. So chemicals, auto anchs, and financials, right, Kenneth?
Oh, the list goes on.
3 areas that you mentioned.
So the list goes on. There's something happening in commodities also. Okay, so the big distraction in commodities was the price rise in all the basic metals. I would say it's a distraction because all companies out there are putting enormous amount of capital to work. I think the largest zinc player is doubling capacity over the next 4 years. The steel manufacturers continue to plod on with capacity, which is equivalent to a 10% growth. They'll bring in 10% annual capacity every year. In aluminium, there's almost 60% of incremental balance sheet getting deployed out there. So I think we have started our we are putting capital to work. Of course, it's not showing in corporate lending because there are other avenues to raise capital. But like I said, Prashant, it's quite broad-based this time compared to what we've ever seen before.
Hi, Kenneth. Good morning. Good to see you, Ben. Kenneth, in terms of cash, you were sitting on around 10%?
That's right.
And you all have started deploying that?
It's not a significant cash number. I mean, my point of view on cash is that I still have 90% invested, right? So that's where the focus is all about. If I get 90% right, 10% is not going to bother us. But just the case on that 10% of cash, we had an exit. So we run a 25 stock portfolio out there, and there's an exit and we've had an exit of one company in that portfolio last month, which is showing up as cash. That should get deployed over the course of the next month or two.
All right. Kenneth, since you briefly spoke about metals, I just wanted your view. I look at your portfolio. Hindustan Zinc has been a decent-sized holding for you all. You have Hindalco as well in there. So non-ferrous, I think, has done relatively better in the recent past in comparison to ferrous. Since you all have both the ferrous as well as non-ferrous names, do you think it's time actually to lean towards ferrous in comparison to non-ferrous? As a fund, how are you all viewing it?
I think it's more stock-driven than it's actually portfolio-driven or everything-driven out there, right? So the ferrous company that we own is basically spanning multiple countries out there, and there's something, and there are reasonable opportunities at both extremes of in both the continents. In India itself, volumes have been reasonably good. In Europe, volumes have not been great, margins have not been great, but then cost savings are coming in significantly. There's also a lot of pricing pressure in Europe. Getting into the next couple of years, I think volume growth in the domestic market and some element of pricing should help in Europe, and you will see a sustainable growth in cash flows coming through in this business. When it comes to the non-ferrous business, each of them have their own dynamic, but largely the way we calibrate our understanding of these two companies is the amount of capital that they're putting on the ground, and how monetizable is their cash flows.
Okay, all right. And I think you were talking about the conglomerate that's going through the corporate action, right? That's the one that you'll have a good chunk. You'll play the demerger.
No, we're not out there. We basically, in ferrous, we are in Tata Steel. The portfolio is domain in...
Okay, the silver play is what you're...
Hindustan Zinc, and we got Hindustan Zinc as far as the zinc and the silver manufacturing.
Okay, all right. The other one I'm looking at is, the capital marketplace. And if I look at your portfolio, I think in terms of exchanges, you'll have gone in for IEX. I'm not sure whether you'll still have it or that's part of your portfolio, I think. So the coupling issue had crept up, which has caused the stock to come down. Your view on this theme on the whole?
So without making a comment on what's happening from a regulatory standpoint, it's a company that dominates that space. Today, I step back to Prashant's question on where do you find value in some kind of these spaces. I think it's a huge opportunity out there. It's an option value on the electricity market, and at the same time, it's traded. If I'm not mistaken, it's about 11,000 crores of market cap with 1,500 crores of cash on book, with 500 crores of incremental cash out there. So this stock is in the portfolio. Most of the numbers are in public domain. But when you talk about value and valuation at this point in time, I think we will overlook the macros in most sectors because the macros can be a little bearish. But that's what also gives you a valuation opportunity in some of these names.
We leave it.
Sorry, I don't know if we have like maybe 30 seconds. Kenneth, on leave us with your pick in the chemical space before you go, if you can.
We've got a front-ended chemical name out there, which is a large international name, but that's a front-ended name out there. We will come back and you will see some part of that translate into our portfolio over the course of portfolio of portfolios. Now that we'll have two funds on the ground over the course of the next couple of months.
I see. Got that. Thank you very much, Kenneth, for that. Really appreciate your time and good sort of thought process in terms of how things are shaping up in a good way. So 26, 27, interesting time, and of course, look for companies where bulk of the capex is kind of behind. The big talking point, of course, remains the IT services space, and I think we've got a couple of companies waiting by. Rima, take it away.
Well, indeed, Ramani Datti, CFO of Team Lease Services, and Kapil Joshi, CEO, IT Staffing, Quest Corp, are now joining in on the show. And before that, I just want to put out one data point. In the first 9 months of FY26, the top 4 IT companies, TCS, Wipro, HCL Tech, and Infosys, have seen an overall headcount decline of more than 700 employees, largely on account of TCS and the restructuring that they did. But in the first 9 months of FY26, the large 4 IT companies have not added any headcount. If anything, it has declined. And clearly, there is a lot of worry because we've seen so many top CEOs, like, Anthropic CEO had warned that AI can eliminate about half of the entry-level jobs, white-collar entry-level jobs. So let's find out what the situation is. Ramani Datti and Kapil Joshi are now with us. Ramani, let me begin with you and what you are seeing when it comes to Team Lease, the extent of IT hiring, new jobs versus the number of people perhaps who've lost their jobs and the number of vacancies.
Yeah, good morning, Rima. As far as IT services is concerned, whatever job losses that we have seen in our industry happened, in fact, much before. By end of 24 and early 25, we have seen job cuts in IT services. And since then, it's been kind of stable as far as contract staffing is concerned. But overall, if we look at IT services, the trend that we have seen is that at entry level and early mid-level jobs, absolutely there is no net hiring that is happening because of the AI impact that we are seeing, mainly the jobs that are into testing, coding, debugging, and IT support, low-end IT skills. So these are the areas typically where the freshers and mid-level talent will be there. So those jobs are, we are seeing the disruption already happening because of AI. But the good news is that at high-end skills, niche skills, there is increasing demand and disproportionate increase in salary pay by both IT product companies as well as GCCs. So overall net impact on the IT investments by the companies is still at a very good level. But if we see only the number of net new jobs that are getting created, since the vast majority goes into entry-level jobs, there we are seeing definitely a dip.
So no job openings for entry-level and mid-level IT jobs, Ramani. Is that clear or is it down? Is there some number?
It's much lower than what it used to be 2 years back. And we are seeing that number consistently coming down. And at least last 2 quarters, we haven't seen a net increase at the entry and mid-level jobs in IT services.
Okay. Is it possible to share the number of job applicants for entry level and mid level. What you have shared is from the company level, that they don't have a requirement for coders, manual testers, etc. But we still churn out so many engineers who are looking for jobs at the entry level. So is there a way to match the demand and supply in terms of numbers? Ramani, and then Kapil, if you could come in on that.
At least on this point, Rima, I don't have any concrete data point, because the way that the skills are also shifting so quickly in terms of the fungibility that is expected by the companies. And also, like, whenever there is an attrition, instead of backfilling, say, there are 5 open positions, companies are not backfilling all the 5 open positions. Thanks to AI, the backfilling is happening only for 2 or 3 positions. So obviously the supply is much higher at this stage across all the jobs, except for the top talent niche skills. But the demand is very much restricted. I would say it's only 30% is the demand in comparison with the supply side.
Yeah. So what are the skills? So when you get demand, right, Ramani, morning, from companies looking to hire, what are the skills they're looking for now in this space?
Yeah. So right now, the top skills that are in demand are the AI engineers, AI analysts, the forensic analysts, and AI leads, data annotators, as well as cloud cybersecurity. So these are the top 4-5 skills that we are seeing as they're in high demand across all sectors, be it IT services or GCCs or product companies.
These are skills, Ramani, where you know. So, for example, the way we say, well, you know, there are lakhs of IT engineers who pass out every year out of colleges, right? You know, what's the preparedness at that level when you get out of you know, educational institutes, Ramani, compared to or I mean, that's not changed yet. So it's all going to be it's all going to be retraining once again. What's happening? Yeah.
Yeah, at this stage, the preparedness of entry-level talent, the freshers on AI-related skills, I would say is very, very low. Maybe to some extent on certain roles like data annotation, since there's still low skill and training of AI models, there we are still seeing some level of demand. But at least at the mid-level and AI analyst level, we are not seeing any kind of fresher hiring that is happening at this stage.
No, because that skill that is not there, Ramani, or it's very hard to find at entry level, or it's you'd want experienced people with some base of knowledge and these skills as well.
Yeah. No, this skill, we can't expect it from the freshers and entry-level talent. Obviously, companies have to invest in upskilling their existing talent, be it entry-level or at mid-level. And that's what we've been seeing now. Like most of the IT services companies and as well as GCCs, they're all investing heavily in their L&D. They're also talking about upskilling their existing talent in AI models, AI engineering, and related areas. So it's definitely at entry level. Right now, there is no skill set that is available on the AI level. But at the same time, upskilling them is also not that difficult. What we have seen is, especially in GCC segment, with 3 to 4 months of upskilling camps that these companies are conducting, they're able to use the existing talent for the new projects that they are taking up.
Kapil, you know, thank you for waiting by patiently. Jump into the discussion. First, tell us what is it that you are seeing in terms of Quest Corp. We understand that specialized AI jobs are in demand, not just in tech companies, but even outside in other services. But at the entry level and mid level, what is it that you're seeing? And also, in a way, if you can help understanding the demand versus supply for entry and mid level, because as we were discussing, there's so much supply. Engineers are saying who graduate that we're not finding jobs right now, but IT companies are saying, or you know, that we don't have enough talent. We're not able to match the talent. So if you could give a sense of the demand and supply, I think Ramani gave a number of 30%, that only 30% of the supply is being met, is being matched with the demand.
Yeah. So, Rima, let me give some statistics because we recently published our annual demand supply gap report. See, I tell you, in India, you know, we have seen almost 1.8 million, 18 lakhs job opening last year. Okay, if you see 50% of them was refilling, still there was 9 lakhs new job got created. But what is happening that demand are shifting, and scoot towards the emerging technology. These are the technology like AI, data, cloud, cyber security, where we see the most of the demand. 2 years back, this emerging skill used to contribute 38% of the total demand. Now they contribute more than 50% of the total demand. Second thing, we see the demand from GCC side. Now GCC plus product company together contribute almost 48% of the total demand. So that piece is growing really, really well. On Ramni's point and your point, yes, we see the demand, overall demand mix. Then earlier it used to be 20% at entry level job, but now it has come down to 15%. But surprisingly, the mid-level hiring has increased, contribution from 40% to 65%. It means organizations are looking for highly talented people who are experienced and those who have experience in the emerging technology. Third thing which we have seen in our report is that tier 2 are also emerging very aggressively. Almost 15% of total demand is coming from the tier 2 cities.
Okay, so tier 2...
And as long as AI is concerned, let me tell you, India has roughly 500,000 workforce working on AI and data, which is expected to reach at 1.2 million by end of next year. But still, we expect there will be 1 million job will be, vacant job will be there. So there is a huge demand supply gap, especially in the GNAI, ML ops, LLM ops. Okay. Some of the AI skills, we have seen 30 to 40% demand supply gap. It means for every 10 open jobs, there are only 5 to 6 job seekers available in the market right now. And reskilling is the only way way forward.
You said there were 18 lakh job openings. Is that related to tech only? Kapil?
Sorry, can you repeat your question?
Yes. You started by saying 18 lakh job openings. This, I presume, is in tech?
Yep.
Okay. And how much would be the supply of talent?
See, demands are skewed towards, there are two angles to it. One, demands are skewed towards the mid-level. Mid-level hiring has gone up from 40% to 65% now. And second thing is the demand earlier, used to be 60 to 65% for your plain vanilla entry-level job, L1, L2 support, infrastructure, testing, business analyst. Now, this is just opposite. Whatever demand you see right now, 50%, more than 50% are, in emerging technology where we see the demand-supply gap. And that is where we also observed that, the fulfillment time to close this position has increased from 45 days to 90 days.
Yeah. I have a question, slightly off tangent rather, not offbeat question for both of you. Kapil, if I can ask you, there is, because IT jobs and job creation there has been such a big pillar of, supporting other industries as well, because these have been traditionally better paying jobs, well-paying jobs at a higher end. There is concern that if net hiring is already negative for some of these companies, large companies, for the last 1.5, 2 years. Given what you're describing, is there reason to be worried? Outside of software, I'm talking about the demand signal for some of the other industries, real estate, for example, and hubs like Bangalore, etc. Any thoughts, Kapil? I'm sure it's a question which comes up, and you've thought about it, discussed, etc. What can you share?
So, see, I am not there is some audio problem, but what I understand, you want to understand the AI impact on the entry level job. See,
no. Sorry. My Kapil, my question. Let me. I think there is we'll fix that talkback issue. I think it's slipping in and out of you. Yeah, Ramani, if you got that, would you want to take that?
Yes. No, definitely the urban India and the consumption and many other related industries which are urban based are still driven by the tech talent. And whenever there is a slowness in overall IT hiring or job cuts in IT, we see that directly reflecting in urban consumption as well. And as you rightly mentioned, real estate can be one of the industries that can be hit. And we have already seen that being hit over the last couple of years because of the overall slowness in IT hiring and IT jobs. And having said that, as I mentioned earlier, while the net new jobs are getting impacted, the overall IT spending is not coming down substantially. So we are still seeing, especially the niche skill, cutting edge technologies and niche skills. So their companies are willing to pay 2x, 3x higher than what it was maybe a couple of years back. So the salary levels are still much higher at top talent level. The biggest hit that we are seeing right now is at entry level. And we are still seeing more and more GCCs coming in, setting up their shops in India, as well as the existing GCCs expanding the number of jobs will to some extent give cushion to this aspect. Because now with the EU deal being signed off, we are also seeing more and more European-based companies setting up GCCs in India. Historically, the majority of the GCCs that we have seen are all US-based. Now we are seeing a lot more discussions happening on the European-based GCC front.
We'll leave the conversation here. Kapil, Ramani, thank you very much for joining in and sharing the insights on this particular issue. We will slip into a very short break. On the other side, we'll get your conversation with Dr. Reddy's G.V. Prasad from the BioAsia conference.
Welcome back. A couple of stocks actually are moving around. Vari Energy is actually that one selling off on decent volume, so it's moved to the low point of the day. Keep an eye out on that one. And the mid-cap tech companies actually have come in for some selling. You look at Persistent, you look at Coforge. These stocks actually the last couple of days have bounced off the lows, but today they have come in for some selling. But moving on then, the 23rd edition of the BioAsia 2026 International Summit is currently underway in Hyderabad. This year's theme, Tech Bio Unleashed, AI Automation and the Biology Revolution. On the sidelines of the summit, my colleague Ekta Batra spoke to Dr. Reddy's co-chairman and MD, Mr. G.V. Prasad, and began by asking him about the company's FY27 outlook and the expected timeline for the launch of its generic semaglutide in Canada. Let's listen in to what he had to say.
There is very little outstanding information that the regulator wants from us, and we will give them whatever they ask for. And if everything goes well, May should be a timeline for which we think will happen.
Okay, so we are still working.
We are just waiting for approval. Once approved, we'll launch. There's nothing stopping us from launching.
So the outstanding issues you would say are resolved at this point?
More or less, yeah.
Okay. Any kind of site inspection?
Usually they may want some information, things like that. There's no inspection outstanding. It is just more information. Information requests we get, and then we submit the information.
How big or how lucrative a market would Canada be?
So Canada, for the initial time when we will be alone in the market for a few months, will be very significant. After that, competition will come in, like any other market, and then we'll start seeing price erosion.
Okay, so let me understand this. When you enter the market initially,
we are assuming. That's an assumption, and we could be wrong. But as far as we know, we believe that we are close to being the only one being approved in the next few months. Somebody may follow after that, and then new approvals may come in. But we believe that we will have some time alone. That would be a nice period for us.
Could you quantify that?
I can't, because it's very difficult.
Okay. What about, what are we working with when it comes to the emerging markets? Turkey, Brazil, China, all of them?
So we plan to launch in whichever market we have access to, where the patents allow us to launch, and also where we've registered the product, or where we have a partner who's registering our product. So we've done a number of registration submissions. We are awaiting approvals, and as soon as they get approved, we'll start launching.
If you had to prioritize the markets at this point in time in terms of how lucrative they are for semaglutide, what would they be? including India?
In the near term, Canada is the biggest opportunity, but that's subject to many things.
Yes.
So if it works out, if it plays out, it could be a sizable market. India, the sheer volume will be high because of the number of people in this country. But at the same time, India will be a very competitive market. There are at least 25 others who are going to launch on day one here. In the other markets, it won't be so crowded at entry time. So in that sense, I think India will be an attractive market in terms of numbers, but it will also be highly competitive. It's also an opportunity to innovate a little bit in the device, things like that. So we don't know how it will turn out. But this category is a large category. The other thing is the life cycle play is also very big in this area. A lot of follow-on drugs are coming from Novo itself, as well as other innovators. So I would say the life cycles of products may be shorter than we anticipate.
Any in-licensing deals that you would then look at in order for newer novel therapies?
If companies are open to work with us and they are not launching directly, we'd certainly love to partner.
Okay. That's one of the strategies that you've taken for your India market, which has grown 19% in the quarter gone by. You've in-licensed products, and that's possibly what's helped the market. Is that correct?
Absolutely. We have started working with innovators around the world, small to medium-sized innovators who don't have local marketing teams here. And we are bringing access to patients, products which they otherwise would not have access to through these partnerships. And some of them are really unique and address a big unmet need. And like our toripalimab, which we launched here, is doing well. And it's also addressing an indication which was underserved in this country.
Are you guiding or are you working with this kind of 15%, 20% growth in India going forward?
No. We generally don't give guidance. But our goal is to, at a company level, be a double-digit growth.
Okay. And what about the US? Because now we have a Revlimid going off.
Gone already.
Gone. So what does it look like in terms of launches and in terms of price pressure?
So there is pricing pressure. That's a reality of that market. Also, we see a lot of increased competition from India itself. Earlier days, we used to see 5 ANDAs, 3 ANDAs. Now it's 20 ANDAs on NCE minus 1 date. So the severity of competition has eroded the attractiveness of that market. But there are still opportunities, there are still niches, there are still exclusivity plays. So we'll do our best to bring products with less competition to the market. But, that depends a lot on the competition also.
But you have a couple of biosimilars in your pipeline for the US.
We do have.
Yes.
Some of them are late now, but we also have some very attractive first-to-market opportunities. They'll start, being meaningful 27, 28 onwards.
Denosumab and rituximab have complete response letters on them.
Yeah.
Would FY27 be when you could probably hear back?
Yeah, rituximab is likely to be launched.
In FY27?
FY27, absolutely.
Okay. Talking about the US, we have Section 232, which the US government has said they're still exploring when it comes to pharmaceuticals. Is that a threat considering that generics play such a huge part there?
The generics is a large portion of the medicines the US patients take. So pricing will be impacted if duties are imposed on that, tariffs are imposed. So my guess is it's less likely to have tariffs because it affects a lot of people, and in the end the manufacturer doesn't have enough margin to absorb duties today. So in that sense I feel and I hope they don't impose any tariffs on generics, and if they do also, I think it'll be absorbed by the market.
Are you rethinking your US strategy considering Section 232 and maybe even MFN, onshoring is becoming quite a big initiative?
MFN is applicable only to innovative branded products. We don't operate in that segment. But we are looking hard at the product mix, portfolio mix in the US to bring up our margins.
A lot of companies have evaluated M&A. Indian pharmaceutical companies, they've at least evaluated large-size mergers. Is that something that Dr. Reddy's is looking at? What is your M&A strategy?
So our M&A strategy is to, look at longer life cycle products, stable margins, and something that can be easily integrated with our existing businesses, more like tuck-in acquisitions. So it will be largely in the space of brands, branded generics for India, for emerging markets, significant emerging markets. And we've also put a stake in the ground in terms of our presence in consumer health. So we are open to branded consumer health opportunities anywhere in the world.
Okay.
But
US would not be a priority?
We do have a US business also. So if there is a branded consumer health opportunity in the US, we will take a look at it depending on the valuations.
Interesting conversation there, but back to the India AI Summit. Shireen is in conversation with Cristiano Amon, President CEO of Qualcomm.
Laptop to buy things online, not anymore. The majority of the world uses phones. The laptop's the exception. So I think what's going to happen is you're going to have those new classes of mobile devices. We see smart glasses. We see things that people wear, like jewelry becomes smart. Of course, wearables become smart because now you carry the agent with you all the time, and the agent see what you see. In case of glasses, hear what you hear. And workloads are going to shift from phones to those new devices. So the phone's not going to go anywhere in the same way that the laptop didn't go anywhere, but it's going to change its usability. It's going to be doing a lot of processing for multiple devices. It's going to do phone things, but some workloads are going to go to like personal AI devices.
I thought you were going to be wearing your Meta glasses powered by Qualcomm.
I should have. I actually got it with me, but I should have.
But let's talk a little bit about India. And I think the objective and the mission that the Indian government has stated very clearly is the idea of democratizing artificial intelligence in India. How do we make that happen? And what do you believe the road ahead needs to look like for that to truly be a reality?
Yeah. Look, I am incredibly optimistic about the opportunities here in India. And I think just to be consistent with everything I said, I think in this conversation, I go back to the past. If you just look when the smartphone, revolution started here in India, if you look at the amount of data that is consumed by a user, India is probably among some of the top in the world. And if you look at how fast the internet developed and how things leapfrog, into the future, especially when you think about digital payments and everything that is now happening with smartphones. When I look of AI, that's going to repeat itself in India, but it's going to be more powerful. The reason it's going to be more powerful is because AI has an incredible ability to empower people. The same way that connecting to the internet has fundamentally changed, I think, people access to information. I think AI is going to take that to the next level. How you get access to information, how you train yourself, how you get instant feedback about things, how you learn about things, how you do different things augmented by an agent, and how the entire economy of agents is going to get developed. I think India has an opportunity to be one of the fastest growing AI nations in the world.
The fastest growing AI nations in the world, because there are questions being asked about the fact that we're just about getting into the LLM race. We don't have the kind of compute capacity that other countries have at this point in time. We do have the talent. That's our biggest advantage. But you truly believe that AI is going to be the fastest AI nation?
Look, let's kind of zoom out, right, and see how this is really is going to play out. If you think about the phone today, right? The phone is the most cloud-connected device in the world. And, it's also the biggest development platform ever created. And if you look about how, you have services, there are some global services, some India services going to the cloud, and you have this thing through phones really democratizing and reaching everything. The way I think about AI, and going back to the conversation about agents being very contextual aware, I think you're going to have different models going to be developed. There's going to be global models. They're going to be Indian models. They're going to be available. But then the real value is how quickly can you deploy this across industries? How many people can you reach with the technology? How many different things? And I think that's the opportunity for India.
Well,
Okay, well, that is the Qualcomm management with my colleague Shireen, and we will go back to it. It's an interesting day of conversations on the sidelines, of course, of the AI Impact Summit. Actually, talking about the AI Impact Summit 2026, let's bring in Ashmit now, who is joining us from Ground Zero with just a kind of sort of preview of what we should expect from there. Ashmit, take it away.
Well, we're coming to you from the CNBC-TV18 Edge AI studio. We're right here at the AI Summit at Bharat Mandapam at the Expo area. Clearly, the big focus, the big talking points have been, as Shireen was pointing out, a lot of the conversations pertain to what the road ahead looks like with respect to AI application, what it means in terms of disruption, not just for jobs, but also for industries. That's only one part of the conversation. The other part of the conversation, and in fact, we're likely to see announcements along those lines later today, will be India's own sovereign tech. We're likely to see India's own sovereign models. Sarvam, the Indian AI company, is likely to launch its own LLM. It's likely to be a 100 billion plus parameter LLM, large language model, that is likely to be launched later today. That is something that we will be keeping an eye on. Not just that, and here's some quirky bits as well. India could very well be landing up with the Guinness World Record for the highest number of people pledging to use AI responsibly. That's something that's expected later today as well. The announcement expected around 11:30 in the presence of the IT Minister Ashwini Vaishnav himself. Those are the two takeaways that we're expecting today. But in the course of this week, as we move forward, a key focus area that we've been hearing repeatedly from the ministry, from the government, from the IT Minister himself is expect big announcements with respect to data infrastructure here in the country. We've already seen the likes of Google, Microsoft, Amazon commit large amounts of money. Between them, over $70 billion. That figure, through the course of this week, is likely to climb higher than $200 billion. Those are the figures that are being estimated, that are being put out by the government themselves. And of course, one key aspect to watch out for will be the inaugural session. That inaugural session is tomorrow. The AI Impact Summit will be launched officially by the Prime Minister, and he will be in the presence of very senior officials from various companies. We're talking about the likes of Sam Altman, Sundar Pichai. They will all be here. They will be present. They will be giving their keynote addresses and hopefully share some color, some insight on what the road ahead in 2026 looks like, not just AI in terms of as a technology, but also in terms of disruption that it's likely to cause, what it means for jobs, what it means in terms of governance, in terms of regulation, and of course, in terms of applications and deployment across industries. Key questions that hopefully will unravel, will get unpacked as we move forward in the space of the AI Impact Summit week.
Thank you, Ashmit. It's an action-packed, and Indian IT is truly at a crossroad. AI for disruption or AI will be an enabler. We will slip into a very short break. On the other side, Manisha Gupta will join in and talk about commodities. Stay tuned. Welcome back. Let's talk commodities now. Manisha is joining us here. Manisha, you're looking at coal, and it's been a while since we've spoken about coal, but it's been steadily creeping up.
Oh, it has been, yes. We haven't had time to talk about coal because we've been talking about gold and silver and copper and various other commodities. But coal needs a mention right now because it has been surging higher. It is up 9% in 2026 till time. It is trading at a one-year highs, and it is inching very close to that $120 a ton mark therein. Well, there are various reasons for the support that coal prices seem to be looking at. To begin with, it is the Chinese regulators saying that they are trying to move to streamline the coal industry. China, remember, is the largest consumer, producer of coal as well. And when China wants to make it efficient and align the overall supply chain, you are looking at support coming in for prices from there. And then it has been about the US as well, directing $175 million in federal funds to upgrade plants and to aid coal-fired power sector as well, especially when it comes to electricity, defense, etc. And that has been supportive. When you look at the supply side issues, well, that is another thing that seems to be contributing to price rise. Australia is looking at weather concerns, a lot of rain there as well. And then you have Russia also facing logistic issues supporting prices. In the Indian markets itself, we are looking at a stronger growth when it comes to coal. There is rising electricity demand. The total demand is projected at 1.5 billion tons by 2030, which would be a record number going forward. Also, when you look at the Indian power sector demand, well, that contributes nearly 73% of total demand, and that has been surging higher. The non-power sector, which is steel and cement, the demand therein also is seen as 470 million tons by 2030. So whichever way that you look, you're looking at growing demand at least until 2030. So it's not peaked yet, as earlier reports were suggesting. Take a look at the numbers here. In FY 2025, we've seen coal production in India hit a record high of 1.05 billion tons. FY 26 is estimated at 1.15 billion tons therein. So we're looking at higher number in this year, back to back in that sense as well. When you look at import numbers, well, yes, India does import, and India imports various other grades like coking coal and low ash thermal coal. In that sense, 243 million tons of an import also is estimated there. My final chart should show you on what we have seen in sense of countries' production numbers and what their estimates are for 2026. So when it comes to China, another increase of a percentage point is what is anticipated in the next year therein, that is this year. India, while of course but a second number in sense of production for coal, is also looking at a growth in production by nearly 3%. When it comes to Indonesia, that could decline by 10%. US production could decline by 9% as well. And when it comes to Australia, because of the weather concerns there, it is going to be a slow recovery going forward into that one there. The markets are anticipating strength continuing in case of the coal prices going forward. There are various reports suggesting that it is going to be between $100 to $140 a ton that you could be looking at coal prices for 2026.
Thank you very much for that. We will slip into a break on that note with the news that it's lower now for the benchmark indices. The Nifty and the Sensex down about 0.25%, and IT is selling off once again. Infy is now the top Nifty loser, extending its fall to nearly 3%. So all of yesterday's perhaps optimism is now being washed away. Tech Mahindra, Wipro also down in excess of 2%. So it's getting quite weak out there. We will slip into a break. On the other side, we'll talk more about the rout seen in IT stocks, not just today, but over the last fortnight or so. Sunil Kaul of Goldman Sachs will join in.